Okay. Let me start first off. We're talking IRS audit considerations tonight, and let me just as a matter of certitude, a factual statement. I don't encourage anybody to fudge on their taxes. I'm not giving this information just to try to get people to see how many corners they could cut or anything. All I'm trying to do is to help you understand what the issues are around this particular topic. The latest statistics that the IRS has published is for 2015, when they audited 1,166,379 returns, which totaled just over 0.6% of all the returns that were filed. Of those 1,166, 1,034, almost 1,035,000 were individual returns, which was just under 0.7% of all individual returns that were filed. Over 70% of those were what the IRS terms correspondence audits. So let's talk about what normally happens when you file a tax return. If you file a return electronically, which they are encouraging everyone to do, and generally close to 85% of all tax returns will be filed electronically. I've got some clients, for example, that just do not want to file electronically, so we don't. But if you do file electronically, the first thing they do when they put the return in their system is compare it to other information that they get. So, for example, if you get a W-2 from your employer, they will compare what's on your return with the W-2 they got from the employer. If you get an interest statement from your bank, if you get home mortgage interest from the mortgage company, any of those items that they get, they do a comparison electronically. They compare that database of all the information they got about that was keyed on your Social Security number, or if you're married filing joint, you or your wife's Social Security number, and they compare it to what's on your return. If they find a significant difference, and I say significant difference in that if it's a rounding here or there, as a general rule, when I prepare tax returns, I round everything based on the 50 cents rule. If it's over 50 cents, we round it up. If it's less than 50 cents, we round it down. So if they find a rounding difference, and I'll illustrate it this way. If you ask for a transcript of your account, when you get it, everything that the IRS sends you is rounded, but it's always rounded down. So you could put something in your tax return and round it up. On their system, they may have it rounded down, so that would be a minor, insignificant dollar difference in the two numbers. They're not going to worry about that. But if they found something that they thought would increase your tax liability or potentially change your tax liability, they would send you a letter. The computer would automatically generate that letter. An individual would not be involved. So this whole process so far is just computer driven. They took your return, they compared it with all the other data they got, and they identified a difference in something, and they sent you a letter about it. They will give you generally a 30-day window, although realistically you have 45 days in which to respond to that letter. As a general rule, the letter will say, you put this on your return, but other people told us this different amount, and therefore we believe that this different amount is what should have been on your return, and we will propose that we increase your tax because of that. Now, there are some problems with that, more so in the past than there are currently. For example, a lot of clients used to fail to give me a sale of a stock that they had. And at the time, the mortgage or the brokerage house would send them that information. Up until 2012, they did not have to put their cost basis on that information. Beginning in 2012, they have to. So letters, correspondence audits that we would get prior to that, you know, they would say you sold this stock for $10,000. They had no information about how much you paid for it, so they don't know if you had a gain or a loss. Their assumption is you had a gain. So of $10,000, you had zero tax basis based on the information they had. So they would propose an increase in tax because of that $10,000 of gain that you had, theoretically. And you would have to respond and show what your real tax basis was and all those sorts of calculations to pay the proper amount of tax, or to get a refund if you had a loss and it offset some of your other income. So now with all that information available to them, they're getting better at proposing correct amounts of increase in tax, but there's still always the possibility that something happened and there was a valid reason you didn't report it. We have, for example, a client that got a 1099 miscellaneous showing additional income for this client when actually what he got paid was interest income. Well, what we will do just to keep the IRS from sending him a letter on a correspondence audit, we will put in the amount they put on the 1099 MISC on the Schedule C on his return, but we will offset that with an equal amount of expense and put a note in the return that, yes, the client received a 1099 MISC, but what was actually being reported was interest income that was being paid to him. And therefore, we have offset that amount of the 1099 MISC and reported that interest income on Schedule B, which is where interest income goes. So there are things that can happen and ways you can deal with these issues. If you get something that's not yours, but it has your social on it, etc., there are things you can do. But the process is all computer driven. They get your return, they do the comparison, and they send out a letter. And if you don't respond to the letter, they will assess whatever they decided was tax. If you do respond to the letter, then they will work through that process and either agree with what you said, or you get into maybe a deeper audit where some actual human being gets involved and something gets resolved from that. So the bulk of what the IRS does is computer matching of information and the sending out of correspondence audits. So of these 1,034,000, 700,000 of them were these letters. I have seen letters, for example, that said, we think you may have missed something and you may want to do an amended return. And that was as a result of the correspondence process, the matching process. And in that particular case, we did want to do an amended return. Didn't have to, but we wanted to get things right. But as a general rule, when they send out these letters, all they will do is say, here's what the differences are, and we think you owe additional tax, or we think you're due an additional refund because of these differences. Of the individual returns with less than $200,000 of adjusted gross income and had non-farm business income between $25,000 and $100,000, the IRS audited 55,597 of those, or about 1 3/4% of all those returns. Now, I picked these numbers for a reason. Most ministers are going to make on a married filing joint tax return less than $200,000. So their adjusted gross income, and adjusted gross income is the bottom number on the first page of the 1040 or the top number on the second page. So the adjusted gross income is going to be generally less than $200,000, but they're going to have business income, i.e. that Schedule C thing if they got a 1099, or the self-employment income. They're going to have that generally between $25,000 and $100,000. So this gives you a fairly decent idea of the population that you're dealing with. 1 3/4% of those get audited by the IRS. On individual returns with less than 200,000 of AGI, but non-farm business income between 100 and 200, they audited 19,000 of those, or just over 2%, almost 2.25% of those returns got audited. So as you can see, as generally as the income goes up, the rate of audit goes up as well. Then we talk about some of the average itemized deduction amounts. And the first screen here we show here is general categories on Schedule A. Taxes, just under $12,000 in taxes. Interest, which is primarily home mortgage interest, although it can be an investment interest and other things like that, just over $9,000. The average of charitable contributions was just over $5,000, just under $6,000. And miscellaneous itemized deductions were about $8,500. And I included miscellaneous itemized deductions because, as a minister, if you have unreimbursed employee business expense up until 2017, it's going in that miscellaneous itemized deductions pot. It goes on to the 2106 and then moves over to the miscellaneous itemized deductions portion of Schedule A. Now, I mentioned as of 2017 that's the case. For 2018, that's a part of the tax return that is no longer deductible. It's going away for 2018 through 2025 tax years. If we break down some of the other pieces of the itemized deduction breakout, income taxes was $9,589. You see the total was $11,900. So income taxes is the bulk of that. Real estate taxes is $4,851. Those two together more than make up that 11,000 average number. And most people that have itemized deductions, the income tax and the real estate tax, and then some ad valorem tax on car tags, is generally most of what you have in there. You are allowed, if you don't have state income tax, to deduct some sales tax in lieu of that. But as a general rule, your sales tax number is less than your income tax number. The mortgage interest piece was $8,700, and you saw that the total interest pot was $9,000. So mortgage interest is the bulk of the total interest. The cash and check charitable contributions piece was $4,708 out of the total charitable of $5,814. So the difference there would be non-cash. So generally about 80% is cash and check, and about 20% on average is non-cash, and that would be things like you give it to Goodwill or Hope House or whatever, the American Kidney Fund, or goods and things, household goods and books and those sorts of things that you would give away that are non-cash. You hear on the radio ads all the time for donate your second car or your used car and to a particular charity, and they will give you a deduction form for it. So those types of things would be non-cash. If you ever have anything in that non-cash that is greater than $5,000, then you have certain issues, appraisals and those sorts of things you have to get done before you can deduct that. If you have anything over $250, you should have some documentation, either cash or non-cash, or check or whatever. You should have documentation. We'll talk a little more about some of those issues later. The unreimbursed employee business expenses. We talked about the miscellaneous itemized deductions earlier, the $8,500 pot of that. The bulk of that, as you see, is unreimbursed employee business expense. The other two things that generally go in this that are somewhat, well, three things really that could be sizable. Union dues would go in here. Income tax prep fees would go in here, and broker investment manager management fees would go in the miscellaneous itemized deductions pot and not be a part of this unreimbursed employee business expense. But as a minister, as we said earlier, if you've got unreimbursed employee business expense, it's going to go in this pot right here. So some issues that we just need to be aware of as far as the IRS is concerned. One thing, the IRS always considers you a minister to be an employee for income tax reporting purposes, but self-employed for Social Security reporting purposes. And as such, the minister should get a W-2. If the church issues you a 1099, that could be a red flag for the IRS to come audit you. Especially if you're doing all the other things as a minister, filing all the other pieces that say you're a minister. So that could be a flag, and they could come audit. Now, they're getting better about making conscious decisions about, is it worth it to go after this person? Because if you're paying self-employment tax, and if you're paying all these things and properly reporting it on a Schedule C, they may not gain anything by auditing you. So they may decide to pass on it in that case simply because there's nothing to be gained by conducting the audit. The procedures for determining housing allowance. If you fail to properly document the agreement of the housing allowance, or the failure to substantiate the various limitations, you remember we said there are three different numbers: the amount of the housing allowance that's in the agreement, the amount you actually spent, and the fair market rental value of the furnished house plus utilities, those three numbers. So if you don't document those, if you leave out some of those numbers on the return, that could be a red flag for an audit. If you get reimbursed under an accountable plan, or if you claim that you have been reimbursed under an accountable plan, and that is not a written authorized plan, then that could be a red flag for an audit as well. If you are audited and you owe additional taxes, now whatever kind it may be of an audit, it could be a correspondence audit, it could be, generally they do three types: a correspondence audit, an office audit where you actually go into the IRS audit or office and sit down with an auditor, or a field audit where they actually come out to your place. Larger businesses generally will be field audits. Sometimes they'll just do a field audit just to give a new employee some training. So if you, whatever kind of audit you have, generally it's going to be a 60 to 90-day period when you're working through those issues and coming to a resolution. Once you come to a resolution, they're going to give you some paperwork to sign. And if you owe additional tax, you generally have three different options. You can pay whatever tax is due immediately. You can request a payment arrangement, and if you do so, penalties and interest will continue to accrue. Or you can make an offer in compromise. An offer in compromise basically says, I want to pay you X in lieu of paying you everything I owe. The IRS, in order to do that, you have to provide them with 6 months of income and expense documentation, and you have to complete a financial statement. Sometimes, if you request a payment arrangement, you have to complete a financial statement as well. As a general rule, if you don't pay the tax immediately, you can request a payment arrangement online, irs.gov, as long as your liability is less than, I believe the number right now is $50,000. You can request a payment arrangement online, and they probably will do that automatically for you. Their preference is on a payment arrangement that you give them banking information, and they just draw the money out, whatever amount is agreed to. They will draw out once a month on a certain day of the month, and you get to pick what day that is. So if that's a payment arrangement and you get into a situation like that, those are fairly easily done as long as the liability is fairly low. And by fairly low, I mean that less than $50,000 number. If you can't pay it on a payment arrangement, and by the way, they have 10 years in which to collect here. So something that was filed that they audited and increased a tax liability on, they've got a 10-year statute of limitations to try to collect that increased tax liability. If you filed an original return, they've got 10 years from the date of filing of that return to collect if you owed tax. But if they did an audit and increase, they've got 10 years from the date of the audit conclusion to try to collect that on. So if you make an offer in compromise, you can propose a number to them, a dollar amount you'd like to pay. They are going to do an analysis, and their analysis is basically going to be, what do we think we can get out of this person over the next 10 years versus what they're offering us. Now, you read headlines all the time about some celebrity that got out of a large tax bill with minimal expense by making an offer in compromise. You hear ads on the radio and on TV all the time about, do you owe the IRS money? Well, those people generally are more interested in taking your fees than they are in actually settling what your situation is with the IRS. And I've seen fees that run tens of thousands of dollars to just get involved with one of those people. And as a general rule, if you've going to pay some kind of money like that, you're just as well off to pay it to the IRS as to somebody else that maybe is promising to get you some special deal. The latest version of the offer in compromise is what the IRS calls their Fresh Start program. You'll occasionally hear promotions and advertising about the IRS Fresh Start program. That's just another version or the latest version of the offer in compromise. So really, these are the only three options you have: pay it immediately, request a payment arrangement, or make an offer in compromise. Now, payment arrangement, they really segregate into different types depending on how long you want to make payments. If you want to make it payments fairly quickly, say within 90 or 120 days, they deem that to be short term, and they're pretty automatic about that. If you want to make payments up to 2 years, for example, those are fairly automatic still. Only when you get above 2 years do they really potentially get into issues about whether or not they're willing to accept your payment arrangement. Another issue that could come up is if a church has non-minister employees, for example, a secretary, she's getting paid. They may have other people other than ministers that are on the payroll. They are required to withhold income tax and Social Security, Medicare taxes from payroll and to pay those in regularly, sometimes monthly, sometimes within a week, sometimes quarterly, depending on the dollar volume of the taxes that they're dealing with. If they fail to do that, they potentially could get then subject to a employment tax audit. And as a part of that employment tax audit, the minister could be subject to a payroll tax audit. So, just as an understanding, there may be ways in which you didn't do anything and it's not your number that came up, but the church failed to do something. And because of that, you got audited or potentially could get audited as a result of something like that. If you're not paying, or the church is not paying, the payroll taxes, the employment taxes that should be paid in a timely fashion, the IRS can impose a 100% penalty for failure to properly pay the payroll taxes on any responsible party. Let me revise that: on any and every responsible party. So if you've got a corporate situation where the payroll manager and the controller and the CFO are all involved and they all know they are supposed to be making these payments and they fail to do it, and the IRS comes in and assesses penalties, anyone who had knowledge, who had the ability to pay, and who failed to fulfill that obligation to pay or ensure that the entity fulfilled that obligation to pay can be subject to this 100% penalty. And that penalty is assessed on the individual, not on the entity that was supposed to pay. Now, the redeeming part of that is that if the IRS comes in and collects on that 100% penalty, they use that collection to offset what should have been paid on the payroll taxes. So the liability for all the other parties would in essence end once they collected from any of the parties what was due to be paid. The IRS requires that 1099s be issued for non-employees who are paid more than $600 in any calendar year. So if you hire, for example, we have policemen that direct traffic when we get out on Sunday morning. They do that year round, and we've got a handful of them, 3 or 4 usually, that rotate that among themselves. So every one of them is sometime during the year going to get paid more than $600. If you have a janitorial person or a custodian that's not an employee, if you bring in a visiting minister, those sorts of things, you should give that person a 1099, you should give that person a W-9, which is the form they need to fill out to report to you the information you will need in order to prepare the 1099 for them. And then once a year, you should go through all the books and records, the treasurer should, and figure out who needs to be issued a 1099 MISC. Because of Georgia School of Preaching and because of the visiting ministers and because of the traffic control people and because of our custodial people, I generally issue 25 to 30 1099s every year just for these types of things. So failure to do that can subject the church to penalties. The penalty used to be $50 per failure. I haven't looked at that penalty number in a couple of years, so it may be more than that now. So if you're supposed to send out 20 or 30 of those, and you fail to do any of them, $50 per each can add up to a sizable number. So yeah, failure to issue 1099s can be an issue that the church can get audited about. If you give a person a W-9 and they do not give you or refuse to give you or give you improperly a Social Security number, then any payments you make to them are supposed to be subject to 28% backup withholding. One of the 1099s I sent out for one of our GSOP instructors, for example, for 2016. I got a letter back from the IRS that said the Social Security number you put on here doesn't match the individual name, address, etc. that you listed. So please confirm that all that information is correct. Otherwise, this person would be subject to 28% backup withholding. So I talked to that individual and corrected. I had miskeyed something on his Social Security number, so we corrected that issue. We have seen situations, though, where the IRS will send a letter that said, if you continue making payments to this person, they are subject to 28% backup withholding. So if you're supposed to sit down and write them a check for $1,000, you would write them a check for $720, and the other $280 you would need to send to the IRS when you filed your quarterly payroll tax returns. If you don't have to file quarterly payroll tax returns, for example, if the minister is the only employee in the church, you're not required to file quarterly payroll tax returns. If you're not withholding from the minister and you don't income tax from the minister. So if you had backup withholding, you would have to file a payroll tax return just to report the backup withholding to the IRS and submit that at that time. Every year, the IRS requires that any charitable contributions that are made via check in excess of $250 that you get a letter of acknowledgement. And that letter of acknowledgement has to include information about whether or not goods and services were received in exchange for those contributions. And we, for example, choose to send a letter to everybody that contributes to us via check. So every year, every week, when I get the contribution, I track all our checks by member. And then once a year, I summarize all that in an Excel spreadsheet and print it out for each individual member, attach a cover letter to it, and pass those out in January every year. But we have on that cover letter a statement that no goods or services were received in exchange for those contributions. A lot of times you start seeing, for example, people that will donate to public broadcasting during their charity drives, during their fundraising drives. And, you know, if you contribute right now, we'll give you or if you contribute $150, we'll give you a t-shirt and a CD. Well, you see on their letters that the value of the goods and services, the t-shirt and the CD you got, was $18.50. So the $150 you sent them, you get to deduct $131.50 because you got goods and services in exchange for $18.50 of that contribution. So if you fail to issue them the letter, if you fail to put on it the statement about goods and services being on there, the IRS can disallow that charitable contribution. There have been court cases, 2015, I believe, was the one I'm thinking of, where they made a $30-something thousand donation to their church, and the church did not send them the letter. Well, when they originally filed their return, they did not have the letter in hand. Shortly thereafter, they got the letter, and the letter did not have any statement about whether or not goods or services were received in exchange for the contribution they made. So they got audited. The IRS disallowed. They got the church to rewrite the letter, and it went to the court, and the court said, because you didn't have the letter in hand at the time you file the return, which is the requirement, and because the letter you did get did not have the requisite statement about whether or not goods or services were received in exchange for those contributions, we disallow the deduction. So a $30,000 disallowance is a fairly significant change in their tax situation. In a 25% tax bracket, I mean, they've got to pay $7,500 worth of additional taxes now. So failure to properly document and properly follow the rules about letters and not sending the letters or not having the right language in the letters can cause a disallowed deduction, which then causes an upset member, and a variety of issues can follow from that. I think we may have briefly discussed this topic earlier, but if a minister is also an elder, and I know some who share both titles, and has total compensation which exceeds $115,000, the church could possibly be subject to excess benefit intermediate sanctions. In addition to the sanctions, the church could be subject to losing its tax-exempt status due to the violation of the inurement policy, i.e. no part of the net earnings of a 501c3 exempt organization shall inure to the benefit of any individual. So if you've got a minister who is also an elder, and as such is a leader, an officer of the entity, then you need to be aware of some of the issues around that if you're paying that elder more than $115,000, and just make sure that things are properly documented so that you don't face some of these issues. All right, that's all I have to cover for tonight. Have any questions?
No, sir.
Okay. Then I will go ahead and close out the recording, and let me stop sharing right here so I can get back down to this. Okay. And I will do the video and post it out there and send out a link for all that. And next week, we'll talk about retirement planning and sponsored plans. The following week, we'll talk current issues in ministerial taxation and internal controls. And then the last week will be our last week of class. We'll do a review and a final exam, and you'll have your paper on choosing to opt out or not opt out of Social Security reasons and discussion. So all that will be due the 8th, and I will see you next week. All right?
I won't be in class next week.
Okay.
We'll be actually traveling to Pigeon Forge for CYC next weekend.
Okay.
On Thursday night.
Well, then if nobody else shows up, then I'll just do the video and post it out as a link, and you'll have to watch it later.
Yes, sir. I will do.
Thank you, Jason.
Thank you, brother.
See ya.